Welcome everyone to the June video of the beginner series on algo trading using PineScript. First, I just want to give a bit of a community update since we are halfway through the series. I want to say I'm really proud of the people that have joined and have had their lives change in trading. Within the community, I give advice not just on algo trading, although that is what I recommend, but for also people who want to discretionary trade. I had done that for a while and achieved a degree of success before deciding that I wanted to build separate income streams with low correlation to each other. This is something I talked about in the first video in this series, and ultimately what the compounder life community is about. And decided I want my time back, or more of my time back, so I can run these other businesses in order to increase my income even further and also decrease the variance and drawdowns that I'm getting as a whole. But for some people, they joined and decided that they wanted to continue discretionary trading, continue on the path. And so being able to help these people and see them achieve success has really been amazing for me. And honestly, this is why I do this stuff, and that's also why this series is free, because I think if you actually watch these videos and put in the effort to code the strategies as I show in the second video of each month in this series, then you will ultimately have a portfolio of strategies that you can incubate. You can trade on sim, and then once you feel comfortable, you can trade live, and then from there also start thinking about how you can come up with new edges and new algos. And so for the people that have joined the community and have been doing well, whether it's through trading or other income streams that we teach, I'm really happy to see the success of those folks, especially this one who is actually going to be retiring in December, and he calls them side hustles, but they're income streams that are strong enough to sustain you and allow people to retire early. And that's something I want to emphasize, is a lot of people get into trading because they think that trading alone is going to be their escape, their out. But really, if you want stability, trading is going to be volatile. It's something I mentioned in the first video in this series. And so being able to set up multiple income streams so that you have that sort of cushion, you have reduced volatility, and you just make more money, and allows you to do things like retire early. And then, for folks who have looked at the monthly cost of the Patreon and thought it was prohibitive, honestly, those are the folks that joined and never did anything. They might have posted once or twice, but ultimately, if you don't have the work ethic, if you can't ask questions, then you're going to cancel, which is by design, because if the cost is too high, then you obviously have not done anything that we teach in the community, because if you had, you would easily clear the cost of the Patreon. And so this is, again, all by design. It's designed to weed out the people that just aren't going to make it, while providing an incredible resource and community to the people who are easily going to clear that cost of Patreon, and in the case of this user here, even retire early. So enough talking about the community. Let's get on to this month's edge. So again, I'm not going to cover the different types of edges in markets. You can look at that specific video in this series. But what we have so far is a bunch of different types of strategies. And last month, we added a day of the week seasonality strategy. And then we're going to continue on the seasonality theme this month with a monthly or end of month seasonality strategy. And then I'll probably have another seasonality strategy for July. And then somewhere between this month and next month, I'm going to show how I actually derive seasonality strategies, which is called data mining. And that's just something I'm going to briefly show here using software like Build Alpha and Strategy Quant X. you can easily mine what sort of seasonal effects occur for specific instruments. I personally prefer Strategy Quant X. And again, if you're a member of the community, you also get access to my workflow files. So if you do decide to buy Strategy Quant X, oh, and I should mention that I'm not affiliated with them in any way. I get nothing if you decide to buy Strategy Quant X or Build Alpha. As far as I know, there's no referral program. I mean, they might have one, but I'm not in it. Again, I'm just here to help you become successful and make money. And this is a picture of Strategy Quant X and the workflows that it goes through. And as I mentioned previously, I'll be adding a video where I show a video between now and July's strategy video. It'll be in this playlist series where I basically go over the Strategy Quant X workflow I have. But to summarize it, basically it clears the existing data banks, then it builds a bunch of algos using genetic evolution, then it tests what I call recency, that's step 3, just to make sure that those effects have not been ironed out. And that's just something you'll see as an edge becomes more obvious. Competition increases, people start front running it, and maybe the edge shifts like 1 day earlier, 2 days earlier, that sort of thing. And then I stitch it together for the full time span in step 4, just so I can see that full equity curve. Then I run a Monte Carlo, which I'll cover, and in this series eventually I'll describe what Monte Carlo is. And then one of the best robustness tests I like to use is testing on correlated markets. So if I'm checking to see if there's a seasonality effect in Apple and I find something, I'll find a correlated market like Google or Amazon, and then I'll see if a similar seasonal effect occurs there. And really all I'm checking there is if I took the same strategy on Apple and applied it to Google, I should make profit. It may not be the same profit as an Apple because the effect might be stronger in Apple, but it should still make profit just because of how correlated those instruments are. So that's just one robustness check I do. And then the second one is system parameter permutation. That's just a fancy way of saying your parameters should not have wildly different results. So if you're doing like an EMA crossover strategy and you're crossing the 5 EMA against the 20 EMA, but then you get wildly different results if you use a 6 EMA and a 21 EMA, that is a sign that your strategy doesn't actually work live. It might have just worked in the past or gotten lucky. And so system parameter permutation, that's step 7, is just a way of doing that sort of check and then immediately discarding any strategies where that sort of weird phenomena occurs. And then the final filter is really all that does is do a bunch of, it basically combines several of the previous steps so that I can see the output of those in a single database. So the best way to think about it is the previous steps, build the strategies and then check them for robustness checks and then discard any ones that don't pass. And then the last step really is just, okay, here's everything that survived. And then here are all those checks again, just so you can review them. And I'll go over this more in more detail in a later video. We'll actually show you Strategy Quant X and every one of these steps in more detail. And then I also want to mention again that Patreon subscribers get access to the ever-growing library of seasonal effects that I discover, along with full strategies with source code, so that you can plot them on a chart and then do the backtest yourself and see the results. So for the strategy this month, this one is called Lower Close on the last day of the month. It's something that I was able to data mine. And the rules are pretty simple. So today has to be the last trading day of the month, and the close of today has to be lower than the prior trading day's close. So basically, it's saying that the end of the month was on weakness, and then if that's true, then we enter long, and then if the market is about to close higher than prior day's high, then we exit. And this is what the equity curve looks like. You'll notice that it seems to be a recent phenomenon because half of the equity curve is flat, but in the list of trades, which I'm not showing, the seasonal effect really takes off from 2012 to today. And one of the challenges with seasonal effects is that many of them have a low sample size due to occurring infrequently, at least on SPY. So this is equity curve of showing this effect on SPY. If you were to look at many instruments within SPY. Like you decide that you're going to expand this out to trade individual stocks, which is usually where seasonality uh, becomes really powerful, is because you might say, okay, well, Apple has the same seasonal effect and also only has like 50 trades in the back test. And how do I capture the seasonality if I'm worried that my sample size is too small? Well, you can usually find several instruments within SPY where this effect also occurs. And then you check the correlations between those. And as long as they're below like 50% or whatever number that you're comfortable with, you can take this trade on all of those instruments and bet that not all of them are going to be losers. And so that's one way that you can diversify. But I personally will just trade seasonal effects as long as there's a reasonable explanation for them. And this is not something I've covered explicitly in the series, but if you are a member community, you might have noticed. Let me just back up into community resources. One of the things that's in the seasonality, the library of seasonal effects, as you can see here, is the first trading day of the month. Tends to be bullish. That's like the third item down here in this screenshot. And I have other seasonal effects that I've documented where effectively the beginning part of the month tends to be bullish just because the market is forward looking, and it tends to, on most months, be predicting or has an optimistic view of what's likely to happen that month. And then as that month plays out, that optimistic view starts to decline as reality settles in. So that's a general trend that you see if we're just talking strictly monthly seasonality. And so that's what makes this strategy particularly strong, is that if the month closes on weakness, there's usually optimism in the beginning of the next month, and you can capture that with this kind of strategy. So even though the sample size is small, it's one that I'm willing to include in my portfolio simply because it's a different reason for taking a trade, right? Like it's going to have low correlation to the other strategies that I'm trading in the daily chart trading portfolio. And so the reason for taking this trade is, or reason for going along is different than maybe another reason a strategy might take a trade in the same portfolio. And so it helps add diversification, adds more trades, and ultimately just improves the overall robustness of the portfolio. So that is this month's strategy. I'll be showing how to code it in the next video, and then somewhere between the next video and then July's strategy, I'll upload a video where I showcase how I use Strategy Quant X for data mining. So thank you for watching, and if you're interested in seeing how to code this month's seasonality strategy, then please watch the next video.